TL is a company based in Nigeria. The company has adopted international financial reporting standards. TL is currently preparing a bid for a government contract to operate a train service on a new high-speed rail link between Abuja and Lagos. The investors' appraisal of the project has been completed and shows that the project is finally beneficial. The focus of attention has now shifted to considering how best to finance the initial investment required in the new rolling stock, that is locomotives and carriages, that is needed to run on the line. The rail link would be operated by TL for a period of 10 years, commencing on 1st January 2020. The new rolling stock 2020. The new rolling stock required would cost 500 million if bought now. So the cost of the asset is 500 million naira if bought outright. Assume that there is an active market in second-hand rolling, and it is established that the rolling stock could be sold at the end of the 10-year period for 220,000. So 220 million. Scrap value 220 million. The following two alternative financing approaches are being considered. Bank borrowing from the primary bank for 10 years term together with outright purchase of the rolling stock, and a 10-year operating lease provided by the supplier of the rolling stock. So we go to bank borrowing and outright purchase. TL would buy the new rolling stock on 1st January 2020. TL can borrow from the primary bank at a 2.5% credit margin. Now, here's the thing. Borrowing rate for TL now is 2.5% credit margin above bank's published rates. And the bank, that means plus bank published rates. And then the base rate, bank's base rate is currently set at 3.5%. So if bank rate is 3.5%, and then TL rate is 2.5% above bank borrowing rate. So which means TL rate is 2.5 plus 3.5%, which is 6%. All right. So, but can be expected to change in line with change the market rates. Maintenance costs are expected to be of order of 15 million per year. So maintenance cost to be 15 million per year if the guy borrows. If TL purchases the rolling stock outrightly. But under operating list, can you hear me, please?
Yes, we are
Can you hear
hearing
me?
now. Now, sir.
All right. So, as I was saying, I said we have this operating list according to the question. So, as I was saying, since we can actually, um, can we hear me, please, class? Sorry.
Yes, sir.
So, the operating list says that there will be an upfront payment of the 2 million upfront payment. There is a need for upfront payment of 58 million at the start of the lease, which is in year zero. Year zero. 10 further lease payments of 8 million each will be payable. That means you're going to pay 8 million naira in 10 years, I mean, in 10 times. All right. We're going to pay further lease payment of 8 million each will pay in 31st December each year, starting from this guy. So for 10 months. All right. So for 10 years, let's say for 10 years, sorry. So it is going to repeat for 10 years. Now the lessor retains responsibility for maintaining the rolling stock throughout the period of the lease and has included the cost of maintenance services within the lease payment. Now, additional information. TS financial runs from January to December. TS corporate tax is 33 point something percent. So the tax is 33 1/3%. Right? Payable annually at the end of the year following that in which tax charge or taxable arises is on preceding year basis. So 100% tax depreciation allowances are available at the time of acquiring an eligible asset such as rolling stock. This payment made by will be allowed for tax when they are incurred. A. Evaluate using a discounted cash flow approach, capital approach as at 1st January 2020, whether it will be cheaper for TS to buy and borrow, or enter into an operating lease for the new rolling stock. Number two, advise on the impact of each of the alternative financing approaches on TL statement of financial position. Advise TL which type of financing approach to choose, taking into account your parties in A and B above. All right. So number one, which is A, is that we want to look at if we borrow to buy, right? So alternative one, borrow to buy. If we borrow to buy, since it's going to be for 10 years, okay, so we need year, we need cash flow, or let's just say item, cash flow, discounting factor, and present value. So everything. So we start from year zero as usual. The cost of the asset is 500,000, 500 million. So outflow. So let me use it as cost of the asset, cost in million, 500 million naira. Discounting factor is after tax cost of debt. Now, this tax rate of 33 over 1/3 is just trying to um, test our whatever. So what it does is it convert it to a decimal. 3 times 33, 99 plus 100. 100 divided by 3 will give us 33.333. So the tax rate is simply saying 0.333, 33.3%. So the after tax cost of debt is the interest rate on debt is 6%. 6 times 1 minus 0.333. All right. So what I give is that 0.1 minus 0.333, right, times 6. That is approximately 4%. So this is 4%. So the cost, the discounted factor is the cost of borrowing. The cost of borrowing represents the discounted factor. All right. So the discounted factor for year one is always 1. So this is 500 million outflow. What else? We're told that there will be a maintenance cost. Okay, we're going to, okay, what cash flow will follow after this one? There's something on maintenance cost. So don't forget, I told you that anytime a person says tax is 100%, 100% tax division allowance is available at the time of acquiring an eligible asset such as rolling stock, which means that our tax savings to this is cost of debt. So from our working through tax savings on um assets. So that is 500 million times tax rate 0.333, since it is 100% tax deductible. So we're going to have 500 times 0.333. That gives 166.5. So the tax savings will come in year 2, which is tax savings on assets, and that is 166.5. Why is it coming in year 2? Because tax is paid on preceding year basis. So the tax of, since the cost is coming in year 0, we believe we are generating cash flow from year 1. So if we generate cash flow from year 1, where we are supposed to pay the capital allowance, but the tax is paid on preceding year basis, so the tax savings on that asset of year 1 cash will be enjoyed in year 2 because it is on preceding year basis. So after tax savings on assets, we are going to have the next item, which is item number 3, maintenance cost. So the question says something on maintenance cost, that I will going to record maintenance cost of 50 million per year. So that means from year 1 to year 10, we are going to incur a cost of maintenance cost, and that is a 15 million naira outflow. But the maintenance cost is tax deductible. So what you are supposed to calculate here is tax savings on maintenance cost. Tax savings on maintenance cost, which is a 0.333 times 15 million. That gives us 0.333 times 15, approximately 5 million. So the tax savings will come in from year 2 to year 11. Tax savings on maintenance cost, which is 5 million naira. So at the same time, there will be a scrap value of 220 million. So in year 10, there will be scrap value of 220 million. But since asset is 100% tax deductible, there will also be room for balancing charge. Balancing charge of year 11. Balancing charge. So 4. Balancing charge. Balancing charge is 220
Sorry,
times.
sir. I don't understand. Sorry. Hello. Can
Go
you
on,
hear?
please.
Sorry. How do we know when to do tax savings? Because I'm lost totally. Like the way you're solving it. The tax saving. How do we know when to do the tax saving? What did the question tell us? There was tax savings, because I didn't. I only gave us tax rates.
If they give you tax rate, what is the essence of tax rate? Tax rate in a question. of NPV. The tax will do two works. One, to as an expense from inflows, and two, as a saving on outflow. Now it says when you read the additional information, DL pays corporate tax at a rate of 33.1 whatever percent,
Annually.
payable annually at the end of the year following that in which the tax charge or tax savings arises. So how am I solving what you don't understand, madam?
I'm asking a question now.
Okay, no, I'm trying to answer the question too, because you said
You've
you
answered
didn't
it
know where
already.
to
You now
mention
still
it.
said, yes,
Okay,
and I understand now. I can ask questions.
okay, good. Okay, good. Now, if you follow the next line, it says 100% tax depreciation allowances are available at the time of acquiring an eligible asset, such as rolling stock. And I've given this information when I was introducing the investment appraisal, that anytime there is 100% tax depreciation allowance on assets, it will give room for balancing adjustment. I told you, please go and check your NPV note where I introduced it, because this part is still part of NPV. We are still working with NPV. All right. So we recognize cost. In this question, I did not give us the rate for capital allowance. That is how those questions used to be framed. Anytime they wanted to take 100% tax reduction on cost, they will not give you capital allowance rate. But they have given us the rate indirectly that is 100% tax deductible. So that means we are charging the tax rate on the total amount of the cost of the asset, which is the second one that is recognized in the two. And then there is maintenance cost that will be incurred 50 million for 15 years, which is from year 1 to 10. But there will be tax savings. Anytime there is cost, there is need for tax savings. So 2 to 11 is the tax savings because it's on preceding year. Then the scrap value, of course, comes in year 10. But since it is an inflow, they should give room for balancing charge, because they do not give us tax putting down value. So tax down value is 0, tax value is 220. They will need to charge tax expense on balancing charge. So I can assume that this 220 is the balancing charge. So 73.26 is tax expense on balancing charge. Are we good? Do you understand now, madam?
But is the balancing charge, is the 73.26 not the balancing charge itself?
No. The balancing charge is 220, and I'll prove it to you now. Let me show you. So balancing charge occurs. Balancing charge occurs when scrap value
Yes.
is greater than
That
tax
should,
written down. So in this case, scrap value is 220,000.
they didn't give us tax written down.
Tax value is 0.
Mm.
So this is balancing charge as well, 220,000. Do you agree with me now?
Okay. Okay.
So in your taxation, if you get your taxable income, what do you do to balancing charge? You will charge your tax first. After you have charged your tax, you will now, you will taxable income, you will add balancing charge to it, so that you will charge tax on the balancing charge. Is that not?
Yeah.
If it was a balancing allowance, you will deduct it from your taxable income.
Mm-hmm.
Your taxable profit, rather, your taxable profit. So you will deduct the balancing allowance before
But
you
you
charge tax.
balance charge, yes.
But you add balancing charge. So that balancing charge you are adding, what we are recognizing here is the tax, that the tax element of that balancing charge is 73.26%. Is it making sense now?
You said the sorry, come again. For just that sentence you just said, sorry.
I said the balancing charge,
Mm.
when you charge tax on the money on the balancing charge, this is what you are going to pay to tax authority.
Yes.
Exactly. So it is a tax expense, not the balancing charge itself.
Itself, okay.
So let me just change it to tax expense on balancing charge. tax expense on balancing charge. Tax expense on balancing charge. So here two different factor.
Sorry,
That 1 point.
Hello, sir.
Yes, please.
Maintenance cost is 15 million per year. And you said from year 1 to year 10, you still use 15 million. So you don't know supposed to be 150.
I think hear you, please.
Okay, I said maintenance cost is 15 million per year. Okay, are we using annuity here?
We're not using annuity.
Hello, sir.
Okay, yes, we are using annuity because we recognize from what year 1 to 10. So we're using annuity.
Yes.
Yes.
Okay, annuity, okay.
This is 8.1%. Now, for 11 years.
Sorry, sir. Sorry. I wanted to just ask it another just one question. The maintenance costs, because from the last question we solved, you said if it's like, for example, now it's 10 years. So when we've considered the zero, then it will now be left with 9 years. I'm just giving an example from what I understood. So in this case now, are we still going to, is the first maintenance cost, won't it be paid in year zero? And then it will now
What's
be
the
left.
timing of this maintenance cost? You should check the timing. What's the timing of this maintenance cost? Did you tell us when it's going to be paid? I'm asking you, madam.
I'm trying to go
The
through
truth
the
is
question.
that maintenance costs are expected to be of order of 50 million naira per year if the rolling stock is purchased outrightly. So they didn't tell us it is at the beginning or at the end. So we can assume that it is at the end of the year. So since it is at the end of the year, they will need to take it to be treating it from year 1 down to the front. Do you understand?
Yes.
The previous one we treated like that is because they said it is paid at the beginning of the year.
Okay.
So that is why we took them to the previous year. So discount factor for 11 years, that is a 1 minus 1 plus 0.04. This is from our 11. Discount factor for year 2 to 11. That's what we want to look at now. Divided by 0.04. So that will give us 8.76. So we now less discount factor of year 1. We now less discount factor of year 1, which is a 1.04 raised to power minus 1, gives us 0.962. So year 2 to 11 discount factor becomes 8.760 minus 0.962. So that gives us 7.798. So we come here and say 7.798 multiplied by 5. Multiplied by 5. That is a 38.99. All right. So for year 10, year 10 is 220. So that's 1.0 raised to power 4 raised to power minus 10. That gives 0.676 multiplied by 220. That is 148. Is a negative figure. So 148.72. And then the last one is 1.04 raised to power minus 11. That is 0.6495 and 73.26. We have a 47.59 in brackets. So we will net it. We're going to get 500 minus 500. We have minus 327.6. Minus 327.6. That is the amount we're going to incur if we borrow and buy the asset outright. So what if we go through operating lease? So option alternative 2, operating lease. So the operating lease here, we have year, item, cash flow, PV, discounted factor, and present value. So I have told you that the discount factor for lease is the cost of borrowing, which is why, because it is the opportunity cost of leasing. So we have 4% as a discount factor. So what are the cash flow I'm going to recognize there? Because is that there is an upfront payment of 15 million naira instantly. So this one is paid in year 0, right? So in year 0, we pay 50 million naira, right? So sorry, upfront payment of 58 million. 58 million outflow, and then we're going to pay another one for 10 years. Don't forget this upfront payment is subject to tax savings too. Any tax charge or tax savings. So that means in year 2, there will be tax savings on initial payment. And that is the tax savings on initial payment. That is 58 million times 0.333. We'll be getting 50 times 0.333. That is 19.31. Which is a 19.31 for year 2. And for year 3, since we know that the discount factor is already upstairs here, so we just pick 0.925. That gives 17.87. So after that, we have another payment of 10 years. We're going to pay 58 million naira for 10 years. 50 million naira for 10 years. And that is the annual payment. 58 million naira outflow. And for 10 years, the discount factor is 8.11. Please, somebody should mute the mic. Hello, class, can you hear me?
Yes, sir.
Sorry, I mistakenly clicked on close instead of muting the next question. So, as I was saying, I said we have this guy, which is tax savings on annual payment. So we're going to pay 8 million naira for 10 years, which is already calculated. This converter is already there. So 3 times 8.11, that gives 470.38 negative. So from year 2 to 11, there will be tax savings on annual payment. All right. So that is going to give us 19.31. And the different factor for that 11 year is 7.798. So 7.798 multiplied by 19.31, that gives 150.58. So let's get the next and again make a recommendation. So this gives 359.93 negative. So if we want to summarize our result, we can see that uh, if we are to lease, if we are to borrow to buy, we incur 327.6 million naira. If we are to lease, we use operating lease, we're going to incur 3593. So what is our advice? We tell them that TL should TL should TL should borrow to buy the asset. Rather than leasing it. So with this, we have dealt with lease or buy under operating lease. Do you have any question, please? Do you have any question, please?